Morning, it's Jeffrey Christian of CPM Group. I'm actually recording this on Friday afternoon, the 2nd of September. Our plan is to release it on Tuesday, the 6th of September. It's a continuation of the discussion that we had last Friday in our video, where we talked about, among other things, the state of the economy, why gold and silver prices had fallen so sharply over the last week or two, and what our outlooks were, but also we did a little bit of discussion about events at the Silver Symposium last week. Because of scheduling problems on Tuesday, we're recording this on Friday so that we can have it ready. And I wanted to go back to two issues. One is the state of the U.S. economy, and I had promised to go into a little bit greater detail then Friday today, and I will. And then I also wanted to talk about silver inventories, which we really didn't talk about during Friday's video, but talk about them now. So I guess the first thing is, let's talk about the economy. This slide last Friday to show, yes, we now have a second counting on second quarter U.S. GDP, and real GDP was down about negative 0.4% contraction in the second quarter. So we've had two consecutive quarters of negative economic activity contraction in the U.S. economy, and that is the classic definition of a recession. There is, on the right-hand side, you can actually see the level of inflation-adjusted real economic activity or gross domestic product in the U.S. You can see that while it is down slightly over the last two quarters, it is actually pretty much at record levels, and it's far higher than it was pre-pandemic levels. While we've seen some contractions in the first half of this year, it's not the kind of deep recession that you see that you normally could call recessions, 1973, 74, 75, 1980, 1981, 82, 1991, 2001, 2007 to 2009, and earlier. So technically we've been in a recession. But if you look at the economy, which is what we're about to do, you'll see that there's a tremendous amount of strength, even as there are challenges and other issues that suggest there is a recession on the horizon, but it may be the distant horizon right now. It may be 2024 or even 2025 or 2026 before we see it. I also made the point, and I've made this point repeatedly, is get away from the labels. Politics, I sometimes tell people when they are ragging at me about stuff, that if you think in terms of conservative versus liberal, Republican versus Democrat, you're part of the problem. You're not part of the solution. If you think that way, you're part of the problem. And the same is true economically. It's not a matter of recession or hyperinflation. Get away from the label. Look at the data, look at the statistics, and see what's going on. And that's what we're going to do this morning. So this is GDP. And you can see strength and you can see weakness, sort of like life. Interest rates are rising. They are now at the lower levels than we've ever seen from 1960 until 2000. And you can see that while they are rising, and CPM Group expects them to continue to rise for at least the next 4 to 7 months, they're still at relatively low levels. That means that the Fed can actually tighten further without running the risks of throwing the economy into a recession. But let's take a look at this thing. Let's see how, if you look here in the period between the recession in 2001 and the recession that started in 2007, interest rates, in fact, did rise. They rose starting around 2004, and they continued into about 2005, 2006, well in advance of the recession. Rising interest rates did not cause the recession. Constraints in growth and other caused that recession. Here you got a period, that is very interesting, say 1993, 1995, interest rates rising. Saw a recession. Go back to the 1980s. Yeah, same thing. Go back to the 1960s, 70s. Yeah, the same sort of thing. Go back to the 1960s, the same sort of thing. We're telling you that rising interest rates throw the economy into a recession, that all prior recessions have been caused by Fed monetary policy and interest rate policy, doesn't hold up to statistical scrutiny. Other things, fiscal policy, real economic supply and demand, also cause recessions. Capacity constraints on the supply side, excessive demand can lead to rising interest rates, which can quell growth, and it can contribute to the onset of a recession, but it doesn't cause it. People like to bash the Fed. They ought to bash the fiscal policies of the administration and Congress, because those things have a lot more devastating and problematic impact on real economic growth in the United States than other places. So interest rates, yeah, they're rising. Yeah, they're probably going to rise further, but let's not get too concerned about them. They're not the thing to watch out for. What else do we have? Inflation. Inflation has risen. It's started to rise in March and April of 2021. 2% in January and February of 2021, but as we came out of that economic recession, you can go back here and see this big increase from a deep recession in 2020. Recessions because it was engineered by the global governments around the world in the face of the pandemic. These other recessions have been more economic things. That was a government engineered recession. And when we came out fast, and we didn't go back to, pre-pandemic levels. We went sharply higher than pre-pandemic levels. And that increase in demand, supply constraints led to a period of higher inflation, starting in March or April of 2021 and continuing at least into June and probably beyond. But you can see July, the month-to-month changes in inflation were zero. So we sort of had a peaking there. That's the top level, is the 1 month percentage change in the consumer price index. The bottom part is year over year, 12-month percentage changes. And there you can see that even there, while we still had very high, greater than inflation, 8% headline inflation, and about 6% core inflation, excluding food and energy, you've seen about 4 months now where the core, ex food and energy, has been rising at a slower level. And you see that the headline has also declined in July. We won't see the August figures until another week or so to see what's going on there. And as I pointed out, in early August, after the July data was reported, in June, you saw significant sharp increases in every sector, every major sector of the consumer price index. In July, you saw small increases in about half of the sectors and small declines in about half the sectors. I shouldn't have to say it, but let me repeat it. The CPI is compiled. There's a list of products and services that comprise what consumers spend. And the CPI is calculated by having thousands of citizens keep a log of what they buy each month, what they pay for each month, and what the costs are. You hear a lot of people talk about how the Bureau of Labor Statistics skews this stuff with various modifications, and et cetera, et cetera, et cetera. But it's hogwash. The reality is that the Consumer Price Index is exactly that. It's an index. It's an index of a survey of thousands of U.S. citizens who voluntarily fill out reports every month and saying, this is what I bought this month and this is what I paid for it. And they keep receipts. Looking at actual data from actual consumers. So when somebody says that the Consumer Price Index is skewed and it doesn't represent real price changes in the economy, turn the page. You don't need to listen to people who think that way. Life's too short. Okay, here's the dollar. The dollar on a trade-weighted basis, nominal U.S. dollar. Hasn't collapsed the way people said it was going to. The gold promoters and the silver promoters have been promising us that the dollar was about to collapse, and it's actually risen. Of course, a lot of them have been promising the dollar collapse for 30, 40 years, and it hasn't happened. But hang around, it probably will someday, maybe long after we're all dead. So much for excessive money supply growth that's going to fuel hyperinflation. We saw excessive money supply growth as the Fed, along with the administration and the Congress, worked to help people survive that engineered recession during the global lockdown in 2020. And you can see the sharp increase in that narrow recession that we had in 2020. And you can see that the growth in money supply, both in M1 on the left and M2 on the right, continued to be high into 2021, which helped fuel that inflation to some extent. But since that time, the growth rates in money supply have normalized, and the Fed is actually kind of constraining. Now, I've been going a little bit longer and a lot slower than I'd like to. I'm sorry about that, but I do want to talk about silver inventories. These are some of the slides that we used last week in our Silver Realities presentation at Stock Pulse's Silver Symposium, and I think they're worth talking about. First, start with the basics. This is the estimates on data of actually reported and estimated silver bullion inventories. Bullion bars, medallions, rounds, and coins. The green thing at the top are taken a greater share of the amount of silver. The blue part, which is really the important part, are CPM Group's estimates of implied unreported stocks of silver. And you can see cobbling these numbers together for decades. And they hold up well in terms of putting them into an econometric model that says this is the silver market, what's going to happen to silver prices. So, the data has been verified by every piece of information that we can find around the world. But in addition to that, you look at the silver price, you look at this data, you compare them, and you say, okay, this makes sense, this holds together. The model that includes these estimates of reported silver inventories, mostly held by investors, jives with and supports and is in correlation with silver price changes over the last 50 years. It's not out of whack. Also, if you look at other people's data, they have miscounted forward sales. They think that there's somehow or other spot physical sales when a producer sells forward. Not when a refiner or a producer or a smelter or other people sell forward, only when mining companies sell forward. It's somehow in their mind or in their view means that there's physical metal that otherwise would not exist that has been sold into the market. And you throw that in and you add it up over the years that they've been in business, and you have more than 1 billion ounces of additional silver supply. Then you look at miscounting about another 1 billion ounces of silver that was refined by Chinese copper, lead, and zinc smelters in the late 90s and early aughties from ores imported from Australia, Indonesia, Papua New Guinea, Bolivia, Mexico, and that stuff is double counted. It's counted as mine production in those countries, and then it came out of China after the base metals concentrates were refined. The arrangement at that time was that the gold and silver byproducts would be exported from China so that they didn't, quote, glut or overwhelm or reside in the Chinese gold and silver markets. So that metal came out, and it was recounted as Chinese exports from undetermined places, probably secret government inventories or something like that. So you have about 2 billion ounces of additional supply that have to be accounted for. And people who do this then use the residual surpluses as a surrogate for investment demand. And they say, oh, there's 2 billion ounces of additional silver that CPM Group doesn't account for. So their investment demand figures must undercount silver investment demand by 2 billion ounces over time. Although, if you look at their model and compare it to the price of silver, they don't jive. You know, they have record volumes of silver in periods of time of falling prices. And sometimes when prices fall, investors do buy more silver. And that tends to push the price up. But it doesn't happen. So this is where we start, the basics. There's plenty of silver bullion around, either in bar form or medallion form or coin form. Now, let's get into market inventories, because that's where a lot of people focus. And you've heard this stuff about how there's been an unprecedented decline in Comex reported inventories and market reported inventories over the last 12 months or so. And you can see here on the right-hand side, there's your decline. It peaked, in 2021, at one point in 2021, early 2022. And yes, we have seen about a 75, 80 million ounce decline in reported exchange and industry stocks in the current precedented. And the precedent speaks volumes about the price implications of that decline. If you go back to the 1990s, you can see that reported inventories were about 350 million, and they fell to 100 million ounces over the course of the 90s. So they fell much more, and they were at much lower levels. And the silver price during that decline in inventories traded between $3.50 and $5.50. Falling inventories, flat prices. But now, let's look over here where we see this sharp increase. Silver hit $49.90 some odd cents in 2011 and fell from then until 2020, late second half of 2019. And during that period of time, especially after 2016, 2017, and here you can see 2019, 2020, and 2021, when silver prices were rising. And what was happening? Inventories were rising and rising sharply and rising to record levels. So rising inventories corresponding with prices rising, and falling inventories corresponding with flat to lower prices. That's kind of weird. Again, you can look at it further, because then they say, well, it's really Comex inventories and Comex inventories relative to open interest, and that's what you have to worry about. These are total Comex inventories, the orange line. These are the deliveries, and you can see there's this vast multiple, sevenfold. There's 7 times as much silver in Comex inventories as there are deliveries in a typical active delivery month. You say, well, yeah, but all those deliveries come from eligible stocks, not from registered stocks. Because you are not allowed to deliver registered stocks. I'm sorry, a little bit of a difference there. You do deliver the registered inventories. You deliver warehouse receipts. If someone wants to take that silver physically out of the warehouse, then those receipts can't become canceled warrants. The receipt is given to the person, and he goes to the depository and he pays an out charge, and he can take the silver out. It's not a complicated factor. In fact, it happens, I think, about 700,000 ounces on average per month during active delivery months. So it's not a complicated factor, and it tends to happen over 2 days. Anybody who says that takes a long time, not there. But the inventories suggest that there's plenty of silver in Comex, and it's not being squeezed. They're eligible and registered, and because you say, okay, you've got record levels of eligible stocks, but registered stocks have plunged, and they have fallen sharply for a variety of reasons related to fabrication demand and refining production trends, and where the metal goes for refining and where it goes after it's been refined from mine production and scrap. And you can see that, yes, we have seen a sharp decline since early 2021 in registered inventories, and they are still higher than they were from 2011 to 2018. They were much lower between 2011 and 2018. And the silver price went from $50 to $12 in 2011, 2014, and then stayed around $12, $13, $14, $15 through 2018. So those low inventories, lower than we have today in terms of registered stocks and in terms of eligible stocks, did not push the price higher. London has only reported its depository inventories since 2016. They rose very sharply during the late teens, 20 teens. They came down with a thud prior to, at the beginning of the lockdown. Part of that was metal moving from London to Comex. And since then they rose back. A lot of these inventories now represent ETF holdings, and they have come off this year, primarily representing, I think half of the decline represents sales by investors of ETF shares, and then those shares are redeemed for metal, and the metal is taken out of the London depository and shipped off, some of it to fabricators, some of it to investors who don't want metal held in London. They want it held elsewhere. Where else? I don't know. But on the right, we have the Shanghai future silver stocks, which they have come off too, but they're still higher than they were at any point prior to, say, 2015. And Shanghai Futures Exchange only has been trading silver since 2012. Different way of looking at the relationship between deliveries and inventories. Again, inventories, record highs in terms of Comex inventories. Deliveries actually have come off some. And they come off, if you go back at the late 80s and early 90s, they were higher because you had more fabricators that used silver taking delivery of refined silver through Comex depositories and through Comex inventories. So you had certain producers and their industrial users who had relationships where the producers would deliver the refined metal into Comex depositories. The metal would actually be sold to the fabricator. At that point, the fabricator would hold those Comex positions for a month, pretty much on a rolling basis, and then take delivery and have the metal shipped to their factories. Those policies sort of went away over the course of the 90s, and you've seen much lower deliveries ever since. And this is silver deliveries as a percentage of inventories. It just accentuates the same thing. So I've gone on much longer than I wanted to. I mentioned a couple weeks ago that we had finished our long-term gold supply-demand price projections, the third quarter update. We finished them a couple weeks ago. We have finished our silver supply-demand price update today, just in time for the Labor Day weekend. We will be circulating that to our clients on Tuesday. And I do want to clarify it. These reports are extremely detailed reports. These are sort of like the premier product of CPM Group, long-term supply-demand projections under three different economic scenarios. They're used by producers in preliminary economic assessments, feasibility, York and 43101 compliant reports on their projects and their mines, regulatory filings, and much more importantly, on corporate development and planning processes. Should we be interested in gold and silver mining? Should we be looking to diversify? Should we be hedging our production? What kind of profitability can we expect under different price scenarios? So these things are relatively expensive. They're $9,500 each. And they're really geared to institutional investors, governments, mints, fabricators, other companies and mining companies, smelters and refiners, groups that have a large, long-term, ongoing financial exposure to gold and silver. Everybody's welcome to buy them. Well, maybe not everybody, but most people are welcome to buy them. But you should know that the price of knowledge is not cheap. You can buy our gold yearbook, our silver yearbook, and our platinum yearbook for $160. Those reports have tremendous amount of historical data as well as projections for the current year and a lot of analysis that helps you understand why gold, silver, and platinum group metals have done what they've done price-wise over the last 50 years. We have the retail investor program, and we have a variety of other services, research, consulting, asset management, commodities management that you can read about at our website. Thanks. I'm sorry I went on long, but the world's complex and there's a lot to talk about. Have a good day. Have a good week. We'll talk to you on Friday, I hope. And be careful. Be good to yourself. Be good to everybody else and the world around you.